Good to see you this morning. So play this out for us here. You definitely were a bit cautious. You thought the S&P could get down to 5,500. It's more or less the intraday low for earlier this month. Where do we go from here?
Yeah, we're in a relief rally, and there's a reflexive response to buy some of the big tech leaders. That's what investors are conditioned to do. So we are participating in that to about 5,850, perhaps as soon as next month. But after that, we're going to have a U-shaped inflation number this year. It's going to drop down the middle of the year to about 2.5. The Fed will feel good about that. That was their former goal, 2.5, before they went to 2.8. But if it rebounds in the second half, there won't be a second rate cut after mid-year, and the market could sell off a little bit on PE going down, even as EPS look okay. So that's the outlook, a trading range.
And so in terms of the underlying economy, we've had this rolling kind of growth scare to varying degrees day by day. Where does that head from here? I mean, do you think that we're going to actually stall out, or is it just going to be muddled through?
Well, the economy is very much yield sensitive. And so the spike in the 10-year yield with about a 3-month lag indicates that economic growth or economic data could soften in the short term. But yields have come back a little bit, so they could pick up by the late second into the third quarter on the economy. So we look at it as a trading range for the year. It's not a recession, which would necessitate 20+% declines for the S&P 500 index, for example. It's more of a slowdown. And because you never know going into a slowdown if it's going to be a recession, the first reaction is always to have a 10% correction or so. And that's what we just got.
The quality and, I guess, value and defensive, more specifically, parts of this market that you lean toward that did provide some shelter during this correction, I suppose they can continue to work, but if it's not joined by the mega cap growth segment, which sometimes acts defensively, it's pretty tough for the overall index to make a lot of progress, isn't it?
Right. And so when you have this yield relief that we just saw, and if you do see, as I said, one rate cut, but that's it for the year, and it ends up being in the middle of the year when inflation is at its low, then your growth stock should participate as well. So investors have to keep 1 foot in each side of the pond, right? So they have to be exposed to what's hot, and they have to be thinking about what the risks are later in the year. Because we have been saying, and I said here on this show, I think Sarah and I had an interview 3 months ago, that mild stagflation was the risk in 2025.
Right. I was going to ask about stagflation because I brought it up in light of the Fed meeting. What is that? First of all, do you think that is an overused word? Is it underused? Do investors need to have some sort of playbook for if that actually materializes?
Well, a few press conferences ago, Chairman Powell was asked about that. And, he's 6 years older than me. So I was a teenager in the late 70s and he was in his early 20s. So he felt it a little more, but this is not the late 70s. It's just that you have sticky, U-shaped ending the year closer to that high twos inflation at the core PCE level. At the same time, you have a softening economy, some would say a maturing economy, and that is a mild form of stagflation.
So the idea that, we have the lagged effect of higher yields working through the economy in the form of a bit of deceleration at this point, how does the sort of suspense about the tariffs and then the potential for high and widespread tariffs play into the growth side and I guess the inflation as well? I mean, Powell was pretty upfront about saying a lot of their inflation projections, at least, are incorporating some best guess about tariff effects.
Yeah, I mean, we went into this year not buying into the Wall Street optimism regarding the administration. I mean, President Trump, his constraint is time. He's got the 26 midterms, the year-end expiration of the Tax Cut and Jobs Act, and the 2-term limit. So we said that he was going to break some eggs to make this populist omelet, and indeed he's moving fast. And Sarah's earlier point about April 2nd, I am concerned about that. splashy headlines on that day. But the Fed's constraint is inflation. We don't think in the middle of the year it'll be too much of a problem. And, unemployment and labor look pretty healthy to us. So we're not overly worried. Again, it's just a little slowing, but certainly not a recession.
Yeah. All right. So we have shock absorbers, but we're probably going to need them, I guess, is the way to think about it. Barry, thank you. Good to speak with you.